The stock market offers investors a wide array of options for building their portfolios. Among these options, exchange-traded funds, ETFs, have become increasingly popular for their diversification and ease of trading. Two of the most prominent ETFs that often catch the eye of investors are the SPDR S&P 500 ETF Trust and the Invesco QQQ Trust. Both SPY and QQQ provide exposure to major indices, making them excellent choices for investors who want to capitalize on the performance of large-cap U.S. companies. In this video, we will delve into a detailed comparison of SPY and QQQ, exploring their historical performance, risk-adjusted returns, sector allocations, top holdings, dividend yields, and expense ratios. By the end of the video, viewers will have a clearer understanding of the key differences and which ETF might be a better fit for their investment portfolio. Overview of SPY and QQQ. The SPDR S&P 500 ETF Trust is one of the oldest and most widely traded ETFs. It tracks the S&P 500 index, which includes 500 of the largest publicly traded companies in the United States. The ETF offers broad exposure to the U.S. stock market, encompassing a variety of sectors. The Invesco QQQ Trust follows the NASDAQ 100 index, which comprises the 100 largest non-financial companies listed on the NASDAQ stock market. The index is tech-heavy, including major technology firms alongside companies from other sectors like consumer discretionary and healthcare. Both SPY and QQQ are market cap-weighted ETFs, but while SPY provides diversified exposure to multiple sectors, QQQ is more focused on technology and growth-oriented companies. This difference leads to distinct performance characteristics and risk profiles. Performance comparison. SPY and QQQ have consistently delivered strong returns over the past decade, but their historical performance varies. The average annual return for SPY over the past 10 years has been approximately 13.5%, while QQQ has returned around 17.5%. In the most recent year, SPY returned about 8%, while QQQ achieved a higher return of approximately 12%. Over the past 3 years, SPY's average annual return was around 10% compared to QQQ's 14%. Looking at a 5-year horizon, SPY's average annual return was roughly 11%, while QQQ delivered around 16%. As of the latest data in 2024, SPY's YTD performance stands at roughly 5%, while QQQ has outperformed with a YTD return of approximately 10%. The variance in performance is often attributed to the higher concentration of technology and growth stocks in QQQ, which tend to exhibit more volatility but offer higher potential rewards. Risk-adjusted performance. The Sharpe ratio measures risk-adjusted returns. Over the past 5 years, SPY has maintained a Sharpe ratio of around 0.80, while QQQ has exhibited a higher Sharpe ratio of approximately 0.95. This indicates that while both ETFs have performed well, QQQ has offered better returns relative to the risks taken. The Sortino ratio focuses on downside risk, providing a more nuanced view of risk-adjusted performance. SPY's Sortino ratio over the past 5 years has been approximately 1.10, while QQQ's ratio has been around 1.30. These figures suggest that QQQ has delivered superior risk-adjusted returns when considering only harmful volatility. Maximum drawdown measures the largest peak-to-trough decline in value. During the COVID-19 market crash in 2020, SPY's maximum drawdown was roughly 34%, whereas QQQ's was around 30%. Historically, QQ has experienced higher volatility and larger drawdowns, with a maximum drawdown of about 83% during the dot-com bubble, while SPY's worst drawdown was about 55% during the 2008 financial crisis. These metrics illustrate the different risk profiles of the two ETFs, with QQQ being more volatile but potentially more rewarding. Sector allocation. The SPDR S&P 500 ETF Trust offers diversified exposure across various sectors. As of 2024, its largest sector allocation is information technology, accounting for approximately 27% of the portfolio. Other major sectors include healthcare, about 13%, financials, around 11%, and consumer discretionary, roughly 10%. This allocation aligns closely with the broader U.S. market, offering balanced exposure across key sectors of the economy. The Invesco QQQ Trust is more concentrated in technology-related sectors. Technology represents around 50% of the portfolio, followed by consumer discretionary, about 17%, and communication services, roughly 16%. This focus on growth-oriented sectors differentiates QQQ from SPY, leading to a portfolio that is more susceptible to technology sector trends and innovation-driven companies. The differing sector allocations of SPY and QQQ have technical implications for investors. SPY's broader diversification provides stability and aligns with long-term market trends, making it suitable for conservative investors seeking consistent returns. In contrast, QQQ's tech-heavy allocation offers higher growth potential but with increased volatility, making it ideal for investors willing to tolerate greater risk for the possibility of higher returns. The choice between the two depends on an investor's risk tolerance and investment strategy. Top holdings. The top 5 holdings of the SPDR S&P 500 ETF Trust (SPY) as of 2024 are Apple Inc. as APL at approximately 6.5%, Microsoft Corp. MSFT at around 5.8%, Amazon.com Inc. AMZN at about 3.5%, Nvidia Corp. NVDA at around 2.5%, and Alphabet Inc. Class A, Google at roughly 2.0%. Together, these 5 companies represent approximately 20.3% of the fund. The Invesco QQQ Trust, QQQ, has a higher concentration in its top 5 holdings. Apple Inc., AAPL, at roughly 12%, Microsoft Corp., MSFT, at around 11%, Amazon.com Inc., AMZN at about 6.5%, Nvidia Corp. NVDA at around 5%, and Meta Platforms Inc., Meta at approximately 4%. These companies account for roughly 38.5% of the fund. QQQ has a higher concentration risk, with nearly 40% of its portfolio in its top 5 holdings, compared to SPY's 20.3%. This means QQQ's performance is more influenced by a few major tech companies, increasing potential volatility. Expense ratios. The SPDR S&P 500 ETF Trust has an expense ratio of 0.09%, which is quite competitive for a large broad market ETF. The Invesco QQQ Trust has a slightly higher expense ratio of 0.20%, reflecting its focus on the Nasdaq 100 index, which includes more specialized growth companies. While both ETFs have low expense ratios, SPY is more cost-effective. Over time, even small differences in expense ratios can affect overall returns, especially for long-term investors. Lower costs typically translate into better net returns, making SPY a marginally more efficient option in terms of expenses. Both SPY and QQQ are strong ETF choices, but they cater to different investor profiles. SPY offers broader market exposure with a lower expense ratio and a higher dividend yield, while QQQ focuses on tech and growth sectors, leading to higher returns but greater volatility. The risk-adjusted performance of QQQ is slightly superior, but it comes with a higher concentration risk. Final recommendation. For conservative investors seeking stability, SPY is the better choice. However, for those with a higher risk tolerance aiming for potential higher returns, QQQ may be more suitable. The final decision should align with individual investment goals and risk appetite. That's all for today's video, and I hope you enjoyed it. If so, make sure to like, share, and subscribe to the channel for more interesting videos. See you in the next video.